Into the red after a day of heavy losses on Wall Street. And EU leaders debate the merits of vaccine passports. Ursula von der Leyen says it's important to find a solution or else big tech will. We have the latest from Brussels. Good morning, everybody. Let's have a look at the futures picture. And it has been negative for the last few hours. Certainly, it has been in negative territory. We are expecting to see losses of more than 1% on equity markets. Of course, this didn't begin or end. This doesn't begin or end with equity markets. Clearly, the links into treasury markets is where this started. And we are seeing selling of other cyclical assets. So when it comes to commodities, certainly that is part of the story as well. So we'll see where these European equity markets open. And we are expecting, as I say, to see these moves to the downside. The FTSE 100 opening down by 0.3%. The IBEX down by 1.4%. And this a continuation of what we saw on Wall Street last night, a continuation of what's been going on through the Asian session as well.
Good morning, everybody. Happy Friday. Just from the beginning, right now, I'm going to place straight away stop on profit for our two euro positions. One we had, as you can see, at 127.8 and another one 122.247. I'm going to place stop on profit at 121.45. Okay, so this is stop. I'll show you what it means. Probably I will have to go to 15-minute chart. And first position we had at 127.68. 120.78. Okay. In second position, 122.247. Stop on profit for both positions, 121.45. Okay. I will adjust everything. So if you been following my trade and open this position, please place your stop on profit. And we'll see how long it will take to, maybe we will put even higher stop on profit. At this moment, we'll keep on this level. Okay, stay safe.
some big buying in Australia out of sync with their normal program. That hasn't helped dramatically. We haven't had the pushback yet from the Federal Reserve, and I think a lot of that's around what I would say is maybe the third thing that could disrupt this, which is, do we see a sustained sell-off in risk assets and a tightening of financial conditions? Because when we look at financial conditions in the US, they are exceptionally easy at the moment. And I know stocks have come off a bit in the last couple of days or so, but still positive territory on a year-to-date basis, having had a very good year last year. So I think there's still, when the central bankers look at this, they will still see that they're not, what's happening at the moment isn't yet disrupting that dual mandate. Now, if we continue to see risk fall from here, then that will be a big question. But I think for now, probably the path of least resistance is for yields to move a little bit higher.
For yields to move a little bit higher, and of course they've come down from that 1.6 we saw yesterday. We're at 1.47 on the US 10-year. What about the steepness of the curve? The 5-year got a lot of mention yesterday. The 7-year auction got a lot of mention yesterday. I'm looking here at a chart of the 5-30-year. I'm wondering what that's telling me. What is the steepness of that kind of curve and the movement we saw in the 5-year yesterday? What is that telling us?
Well, we'll start with the 7-year. I think that obviously the auction was interesting, and to be honest, that is going to raise a couple of warning signs for Fed members and obviously Janet Yellen over at the Treasury, and they don't want to see those sorts of misses. So that will be a concern for them. I think when it comes to the curve, as I said, the steepening had been in line with what they were hoping for. It was highlighting that inflation expectations were picking up, growth expectations were picking up, and that their policies were working. Now, again, what happened yesterday is that the market pushed back on that and said, actually, it's all well and good with these growth picking up, but you're going to have to normalise policy sooner. And again, I think that's something that the Federal Reserve will be keeping an eye on, because they do not want the front end of the yield curve to move away from what they're expecting to happen and what they're telling the market is going to happen.
Ian, thank you very much. Stay with us. Ian Seeley, JP Morgan Asset Management, International CIO for Fixed Income. We will get more of a European angle on that conversation. We've heard from the ECB's Philip Lane. We'll talk about what he's been saying about the ECB's response. We'll talk about what bond markets are doing in the face of these movements in treasuries. We'll also talk about the vaccine rollout. Coming up, AstraZeneca's CEO has defended his company's delivery delays during an EU committee meeting as Europe rushes to ramp up its faltering vaccine drive. We have the details next. This is Bloomberg.
Okay, we close position on 121.45, so you should close to your positions on euro at 121.45. Well done. You can collect your profit.
Women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
When we look at women leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women had a very clear objective. They wanted to save lives.
The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected as leaders, whereas this doesn't hold true for men.
We need to get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
Generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
And the fight against climate change, Bloomberg Green has you covered.
If the recovery in the economy takes place as we hope in second and third and fourth quarter, we could even see rates to go higher and the key rates to be raised later on this year. However, it remains to be seen whether the sell-off in the bond markets really is sustainable. We have seen that several times in the last few years, and it was very quickly being bought off again.
That was the Erste Group CEO speaking to me a little bit earlier on about the bond sell-off. The Treasury sell-off seems to have paused for just this morning, at least here in European time, but that hasn't stopped stocks from selling off. That said, we are already off earlier lows when it comes to this stock sell-off, so some people taking the opportunity to buy these dips. The Stocks Europe 600 down by 1.3%. The FTSE outperforming just a touch, down by 0.9%. Let's have a look at US futures. NASDAQ futures had been coming off earlier lows, and they continue to do so. So we're now down by just 0.2%, which is not as severe a sell-off as had been flagged earlier on by those futures. Let's look at the latest on vaccines in Europe. AstraZeneca's CEO has defended a shortfall in deliveries during a European Parliament grilling. He said employees are working around the clock to increase production. Europe is lagging behind its international peers in the vaccine race as the UK, Israel and the US steam ahead. Let's get the thoughts on what all of that does to the varied outlook across the Atlantic. Ian Steely, JP Morgan Asset Management International CIO for Fixed Income, is still with us. It's interesting trying to join the dots between what I just set out there on the European vaccine rollout and what we're seeing in markets right now, Ian. And I was reading some people linking these two phenomena by saying if the US is allowed to grow so much more than Europe, that is part of the instability that we're seeing in markets at this point. Do you attribute some of this volatility to a much stronger growth picture in the US and a lagging picture in Europe?
It's a good question. I think definitely the Treasury market is fixated on the good US growth picture. I think bonds to some extent and the European government bond market have been taken along for the ride with what's been going on in the global context. And when you look at the movement in German government bond yields, it's been fairly dramatic, I guess, in a sense of where they've been and the volatility we've seen in it. But it's not been anywhere near as high as other markets. And I think the reason is, as you mentioned, when you do look at the growth outlook in Europe and the inflation outlook in Europe, it just doesn't look as strong as other markets around the world. You've still got consistently, projections of low inflation, well below the ECB's target. The vaccine rollout isn't going particularly well over there at the moment, and again, that's questioning the growth prospects over the second half of this year. And when you look at some people's growth forecasts, they are actually coming down slightly in Europe, which is in contrast to the US, where they're going up quite significantly. And I think the argument would be that is why you've actually probably, if of all the central bankers around the world in the last week or so, you've seen more pushback from the ECB members, whether it be Lagarde or Philip Lane yesterday, pushing back and saying that they're keeping a close eye on long-end yields, and they have the ability and the purchase program to do more if necessary.
Yeah, absolutely, because US growth might be a gift to the world in the sense that, if that ship rises, it does take it might take that tide might take other boats with it, Ian. But at the same time, Europe doesn't want to pay a cost of money that is higher than its underlying economy would justify. And it's interesting to see, as you point out, we've heard from Christine Lagarde, the ECB's Philip Lane saying, without a doubt, the ECB has more ammo if there is another shock. I mean, what are they thinking about here at the ECB, do you think?
I mean, I think they have got some more ammo, but as we know, that the toolkit is fairly empty. It doesn't look like they want to be cutting rates any further, and the more ammo would be that they can use the PEP program and they can adjust it, and if necessary, and they can focus on certain markets or certain parts of the curve if required. So I think it will be interesting over the next couple of weeks when we get the numbers from the program as to whether they have been doing any additional buying. The market wouldn't indicate that at the moment, just given the movement we've seen in yields. At the moment, I think it's more trying to do verbal intervention and push yields down, or at least stop the.
Hey guys, well done. As you can see, I showed our profit. What we did today, we sold a couple of days ago euro. It went up. We hedged we sold at the higher level, and then we closed position on the middle. We collected our profit. Well done, guys. All of you who followed our trades, we made well. For other people, if you want to get the strategy, you know where it is. It's on the screen in red. Pick a line. I'll speak to you later. Stay safe.
Of the recovery.
So I think it is a challenging one at the moment, because obviously the movement that we're seeing in treasury yields is really underpinning everything within the fixed income market. And if you look across all fixed income sectors, with the exception of the high yield space, you're in double digit, or sorry, a couple of % negative returns across a lot of markets. Now that is creating some opportunities. We do believe that a global reflation and a pickup in growth globally should be beneficiaries to the emerging markets. We've seen some weakness in their currencies over the last couple of days. It's really, I think it's more the speed of the movement higher in treasury yields. If we can get a bit of stability, I do think there's some opportunities there. Emerging market currencies still look cheap to us relative to history, and there's the one asset class that didn't perform last year. So I think there's some value to be had there. And then for a lot of other markets within fixed income, it is more of a carry game. Unfortunately, if I look at the spreads on things like the high yield space at 350 basis points, you're not going to get a huge amount of capital appreciation there. But if you can get yields of 4 to 5% over the course of this year, I think most people would take that at the moment.
Okay, thanks very much. The hunt for yield goes on then, even as these treasury yields have been moving to the upside. Ian Steely, thanks so much. JP Morgan Asset Management's International CIO for Fixed Income. Ian will be continuing his conversation with us on Bloomberg Radio. That's at 9 a.m. UK time. Coming up on the programme, nearly 20 minutes into our European trading session, IAG posts a $9 billion loss. We'll bring you the latest on the British Airways parent company next. This is Bloomberg.
Nuestro país, igual que los demás países del mundo, no está preparado para esta pandemia. Más aún, los más afectados son los países de desarrollo como el nuestro, ¿no?
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
welcome back to the European Market Open. We're 21 minutes into our trading session. We're recovering off earlier lows, but still very negative here on European equity markets. Catching up with the US of yesterday. Will the US of today look different? Well, perhaps it might. We had seen negativity on US futures, but that does seem to be turning itself around. If we just roll through and show you those, E-mini futures now in positive territory, NASDAQ futures just in to positive territory as well. So still all to play for on the US session ahead. Will we see cyclicals, though, selling off in the way that cyclicals have been selling off here in Europe? Now, British Airways parent IAG posts a $9 billion loss for 2020. The airline group says it can't provide an outlook as the coronavirus pandemic continues to batter air travel. Joining us now is Bloomberg's European Airlines reporter, Siddharth Phillip. Sid, very good to have you. The latest on the earnings story then is of interest, and also the fact that they just don't know enough to provide an outlook.
Morning, Anna. Yes, at the moment, it's pretty hard for IAG, especially as, unlike other discount carriers, IAG has a large chunk of its money that comes in from long-haul flying, especially the more lucrative transatlantic flying, really. So for that reason, that's why IAG sort of said that they can't really offer an outlook for how demand is going to fare over the next year, as obviously there's still sort of questions remain about when will travel really return.
Yeah, it must be great to be an executive in an airline that, relatively great, it's none of it's great, but better to be for an airline that has a large domestic market. And when you fly across the Atlantic, this must be a big challenge. What are other airlines doing then? Why are they different to IAG?
Sure. So, like I said, that IAG, especially BA, depends on transatlantic business, especially on business travel, whereas short-haul specialists like EasyJet and Ryanair are counting on a quicker rebound as the UK unveils a roadmap for short-haul travel recovery with the vaccination campaign. So IAG has been obviously harder hit, although the airline does say that summer might be promising, especially with the rate of vaccinations, and they've asked for an international commitment to digital health passes and wider COVID testing in order to reopen travel and remove travel restrictions and quarantines.
Yeah, it's almost possible to imagine a summer now, Sid, isn't it? At least the sun is shining. If you are in London, the sun is shining this morning. Bloomberg's European Airlines reporter, Siddharth Phillip, thank you very much for that. Let's get back to the broader market story, global bond markets. The sell-off there easing, but that has been putting pressure on high-flying, risky assets. Everything from US futures to Bitcoin and copper has been moving into the red this morning. But things just starting to turn around once again, Danny. Things getting a little bit better for risk assets. What are the ripples you're looking at?
Yeah, I think part of this has to do with digesting some of the bond sell-off easing, maybe people going in and buying and really saying, okay, let's turn to the Fed, let's turn to the ECB and see if that invisible hand to support the bond market is going to be coming back in. At least we heard that from some degree from Philip Lane, saying that there's plenty more ammo left from the ECB to support a shock. So this picture helping out somewhat the equity picture, S&P 500 futures turning into the green, but there still are pockets of stress. We look at Stock 600 down nearly 1%, and Russell 2000 futures, so this is the small cap, at one point was down more than 1%. That too has eased off 0.5%. Of course, that's still more than we've seen for the S&P 500 futures. So it really is a day where some of those momentum trades are coming off a bit. And part of the reason they're coming off is the story of higher yields. Yes, it is easing, but when you get this violent move upward, and the violent move upward of yields crosses that of the dividend yield of S&P 500 stocks, you start to reevaluate your position. Or if you were looking for a market top to sell into, this gives you a good opportunity. So I think it really is taking money off of the table at a time where you have the shocking bond move.
Yeah, and when things move so quickly, you ask who's going to get hurt. And we have seen such participation from retail investors lately, Danny.
We have, and look, things that are moving lower, it's things like Bitcoin, it's high-flying tech, it's the ARK ETF. So those are the kind of things that retail really likes, but they did buy GameStop, of course, yesterday, Anna.
Danny, thanks very much. Danny Berger with the latest on these markets. Coming up on the programme, the world is slowly but surely shifting to a greener future. We'll speak to the CEO of the Portuguese utility company EDP, which is promising to significantly increase its investments in clean energy. It's been fascinating that through the pandemic, we haven't seen a step back from the green agenda. If anything, companies and governments have been taking the green agenda increasingly seriously, and we've certainly seen that from China, haven't we? So we'll continue that conversation next. This is Bloomberg.
the biggest mistake you made when you were a fresh MBA grad and looking for a job?
Make sure you try to do something that you're interested in and that you think you'll be good at. I just was on a path to law school, and I actually never asked myself why I wanted to go to law school. And I randomly went to an investment banking analyst recruiting event, and I figured out I had an aptitude for it. I was interested in the work. If you're not interested in it, and it's not something you're good at, the money will not justify it. I also think that there's nothing wrong with experimenting. Doing something that you always thought you might want to do, or trying it for a couple of years, you can then go back down a traditional path if that's what you want to do. Try to remember what you want out of a job, where you want to live, what you want to get from it, from personal experiences, from development, from training, from fulfillment, from engagement in the community, and make sure you think about those things up front as you're recruiting and not try to evaluate it after you got there.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Welcome back to the European Market Open for a Friday morning. It's a busy one, 30 minutes into your European trading day, and we are already off lows of the session. We opened down by more than 1% on many of these European equity markets. We have pulled back a bit since then, now down by around 0.75% on the stocks 600. US futures also have been negative through the night, but now looking a little better. So NASDAQ futures actually leaping to the upside, up by 0.3%. E-mini futures up by 0.2%. So are we drawing a line in the sand? We've certainly seen a bit more stability in the bond markets, treasury markets trying to stabilize a bit. Yields came down from those more extreme levels yesterday of over 1.6% down to 1.48 now. And so with that, you might have thought we'd seen a little bit of the tension come out of the stock selling story. That didn't happen through the Asian session, but now it seems to be happening as we look at US futures. Let's have a look at the sector picture then and show you a breakdown there. Here in Europe, we see most sectors in negative territory. So even if we are off lows, still most sectors are negative. There are a couple to the upside, both of them bond proxies, if you like, sectors that you might consider safe havens. And we are seeing some selling still of some of the more cyclical names, so basic resources and energy, adding to the earlier selling that we'd already seen in earlier sessions in technology stocks. Let's move on to the green agenda. Green energy is a hot topic in 2021, with governments and business leaders committing to a cleaner future. Portuguese utility company EDP, which operates in 20 countries worldwide, says it plans to invest 24 billion euros in the energy transition over the next 4 years, with about 80% going to renewables. I'm pleased to say we're now joined by Miguel Stillwell, EDP's CEO. Miguel, very good to have you on the program with me this morning. Let me ask what's going to set you apart then in the race towards renewables, in the energy transition. Many energy businesses are turning to renewable energy. What will set you apart from the others?
First of all, good morning. I think the first thing is that we have a strong track record investing in the renewable space. We've already been doing this for 15 years. We have 20 billion euros already invested in the renewable space. And as you said, we have the plans to invest another 24 billion over the next 5 years. So we have the track record, we have the team, we already have the global footprint, and we have the projects in place to continue to invest profitably in all the different geographies.
In terms of the types of renewable energy, wind energy has always been central, or has been recently central to your strategy. Now solar seems to be taking the spotlight as well. What's happened to solar to sort of push it up your agenda?
So I think one of the global trends that we've seen is really all the renewable technology costs coming down and really becoming very competitive against the more conventional technologies. In fact, nowadays, renewables, wind and solar are by far the most competitive in the market. Solar has obviously come down a lot, and so it's obviously taking more of a market share. And so we see more potential growth for solar. also over the next couple of years. So really, in terms of our mix of investment over the next couple of years, we see it pretty much evenly split between wind onshore and solar. And we see that both in Europe and in the US, which, as I think you mentioned, we have 80% of our investment going to both of those geographies. So US and Europe spread throughout, so not only Iberian Peninsula, but places like France, Italy, Poland, Romania, UK. So we're investing in all of these different countries.
Are you interested in acquisitions in the solar space? Is that where you're looking?
No, we've done most of it organically. As I say, I think we have already a strong track record. We built up the teams. We know how to do the development on the ground. And what we're seeing is a lot more projects that we are able to develop in the different geographies. And solar is becoming, as I say, very, very competitive. And we've been doing that already with our teams, building up the pipeline. We have more than 40 gigawatts of pipeline that we've developed over the years. And so we're beginning to bring those projects online. We already have over 7 gigawatts that have been secured over the next couple of years for 21, 22, and 2023. And what we're projecting is that we have a total of around 20 gigawatts over this period, 5-year period until 2025. So it's a very strong, very ambitious investment program that we have over the next couple of years. But as I say, I think this is really a multi-decade trend, multi-decade macro trend that we're seeing. And so we certainly expect growth to continue to ramp up. Just to give you an idea, I mean, we're basically doubling the pace of growth versus the previous years. And we think it can go even higher than that. And this is clearly, if you want, our stepping up to the challenge of the climate change. I think it is a major macro trend, and we are seeing that across all geographies, across all regions.
I just want to jump into the conversation, Miguel, and bring some comments from an ECB Executive Board member, Schnabel, speaking at a virtual event, a red headline across the Bloomberg. Schnabel is saying that the ECB may need to add support if yields hurt growth. And that's interesting in the context for viewers who've been with us a while, in the context of the conversation we were having with Ian Steely earlier about how Europe maybe is more worried about this push up in yields than the US at this point. And Miguel, that brings me back to you. Are you concerned about a rising bond yield environment, either because of what it does to your own funding costs or because of what it does to the relative attractiveness of renewable assets at this point?
I think fortunately not. First, we've significantly reduced our leverage, so we have already a pretty comfortable balance sheet. Most of the assets we invest in are inflation linked, and so they are able to withstand, let's say, any impact that might have there. In terms of the actual interest rates, I mean, we've already built that into the business plan, so we're already assuming some increase in interest rates over the course of this next couple of years. So I think as long as it's reasonable, you know, that's perfectly acceptable and perfectly doable. I mean, I just think that with all of the growth, obviously people will adapt, they will adjust their returns accordingly going forward, obviously assuming that it's within moderate rates. So I'm not overly concerned about it.
Okay, in terms of the structure of your business, EDPR is in focus. This is the Renewable Energy Unit. When do you think you might have a decision on that unit issuing new equity?
So to say, EDPR is a listed vehicle. It's been listed already for 12 years. At the appropriate time, and we haven't specified exactly when, we could issue around 1.5 billion euros of equity, basically to finance this plan. So it's, as I mentioned, it's 24 billion of total investment that we're doing, around 20 billion, 19 billion to be invested specifically in renewables. And so we think EDPR is the right funding vehicle to do it in. So it's, you know, had a fantastic performance over the last couple of years. It's had a great track record in terms of building out its installed capacity, both in Europe and in the US, which are its primary markets. And so we think that bringing in fresh equity and allowing us to fund this plan going forward would be a great way of doing it. As I say, we haven't specifically given a time frame for it. It will be at an appropriate time to institutional investors.
Okay, thank you very much. Thanks for joining us, Miguel. Good to speak to you, Miguel Stillwell, the EDP CEO. I just want to get back to those comments from the ECB. Isabel Schnabel from the ECB saying there may be a need to add support if yields hurt growth. Going on to say that the ECB still has some room to cut interest rates, and we're watching this live feed right now, this live stream of what she is saying from the ECB. The ECB, she's also saying that the benefits and costs of deeper rate cuts must be weighed. So the ECB still has room to cut interest rates, she says, as we have seen some of the European bond markets sort of swept downwards in terms of price and upwards in terms of yield, following what we've seen in treasury markets, but without the underlying European growth story to go along with the underlying US growth story. So no doubt worrying some at the ECB. Let's get a Bloomberg First Word News update for you now. Here's Laura Wright.
Thanks, Anna. President Biden takes his first known military action, carrying out airstrikes in Syria on militants backed by Iran. The Defense Department says multiple facilities were destroyed. The assault comes after a series of rocket attacks on US forces in Iraq. Next month is the 10th anniversary of the Syrian civil war. A US intelligence report is expected to say that Saudi Arabia's crown prince approved the killing of Washington Post columnist Jamal Khashoggi. A source tells Bloomberg it may be declassified as soon as today. The prince has denied any involvement but says he accepts symbolic responsibility as the country's de facto ruler. Senate Minority Leader Mitch McConnell says he would support Donald Trump again if he is the Republican Party's nominee for president in 2024. His remarks to Fox News are an about-face from comments less than 2 weeks ago. He gave a speech in the Senate saying Trump was practically and morally responsible for the mob that attacked the Capitol on January 6th. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Anna.
Thank you very much. Laura Wright here in London with an update on the news you need to know. Now, Israel just passed a major threshold with half of its population receiving at least one COVID vaccine dose. The country's health minister, Yuli Edelstein, spoke to Bloomberg yesterday about the milestone.
I'm really proud to say that as we speak, we are crossing the line of 50% of the general Israeli population getting at least the first jab. I think that the main reason was to start negotiating early, understanding that we are a very small market. The moment companies will actually have the vaccine, they won't even look in our direction. So we started early. The Prime Minister, I do have to say, was actively involved in crucial stages in trying to negotiate the best dates possible. And then our medical teams, our HMOs, came into action in an incredible way. The results are that in 2 months, we reached, as I've said, about 50% of the general Israeli population. And we have to keep in mind that right now we don't have the permission from Pfizer to vaccinate kids under the age of 16. So I think it is a very impressive result.
Have you had any surprises up until this point as you've vaccinated 50% of your population?
Well, the surprise, first of all, there's the psychological aspect that we just started talking about. Definitely there is this kind of a sigh of relief that comes a little bit, I would say, prematurely. People don't understand why, if they've already been vaccinated, they still have to wear masks, so they still have to keep social distancing, which in a country like Israel is very difficult. You know, we are warm, we want to embrace, we want to get close to each other. And so the psychological aspect is not easy. But there's also, I think, in terms of it's not a surprise, it's a fact. There is something that we have to keep in mind. The vaccine is very effective. We just had the research that shows the effectiveness of the vaccine. But if we are talking about, let's say, 100 people, all of them vaccinated in a certain event, out of them, five or six are surely not reacting to the vaccine. So the danger is always there, and that's what we are trying to explain to people.
Really interesting there, the thoughts from the forefront of the vaccine rollout, Israel's health minister, Yuli Edelstein. Coming up on the program, we are 42 minutes into the European trading session. We'll take a look at some of the biggest movers, some of the overall themes dominating the market, perhaps overriding the earnings story today. But actually, we're off our lows of the session. We're paring back some of those losses as US futures turn increasingly positive. This is Bloomberg.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Welcome back to the European Market Open. 45 minutes into a negative trading session, but decreasingly negative as US futures turn a bit more positive. We got a breaking headline across the Bloomberg. This relates to El Caterton, an investment vehicle that is backed by LVMH. It is dedicated to growing middle market companies and emerging high growth enterprises. The focus of the news today is that El Caterton has acquired a majority of Birkenstock. This is according to the Handelsblatt over in Germany, but we're flashing it across the Bloomberg. Comfortable footwear, perhaps, is all the rage during a pandemic. So we've just been through what's going on the markets more broadly. Then joining us with a deeper dive, if you like, is Bloomberg's Danny Berger. Danny.
Yeah, deals wait for no sell-offs, right, Anna? Well, to start it off on a positive note, and part of the reason we're able to see markets start to turn around a little bit is because bond proxy type stocks are being bid up in this environment. So utilities, one of the few sectors to be solidly in the green today, along with healthcare. Yes, they are more safety plays, but when you think about a bond proxy, you think about something that's popular in a low rate environment, perhaps getting support from ECB members saying that there's more ammo left that they may need to step in should high yields become a problem. But let's also look at some of the sectors that are solidly in the red as well. Now, one of the ones that's falling is anything that's tied to some of the resources. So we're looking at miners falling, oil and gas. Copper has started to fall again. So Basic Resources Company down nearly 2%. We're looking at some of that super cycle commodity trades coming off a bit, perhaps the higher yields, giving investors an opportunity to rethink the past few months of that buy everything rally. Now, one sector that has turned around in the US but is still in the red when it comes to the European session is tech. Now, if you want to dive into the factors that are moving, momentum is the worst performing factor in the European session today. So that's why we're going to see something like tech do poorly. Again, it is that reversal of that buy everything, and what's benefited from that, it's those high flying valuations. I want to get a quick look on the macro picture as well, because one of the important parts of this story is the fact that 10-year yields in Europe have started to turn around. We're looking at bunds finally getting a bid on this side of me over here, and that's really helping the broader picture of the market. But we're still looking at a lot of risky assets sell off. For example, we have copper not doing well. Again, that's why I said some of those basic resources companies were taking a hit. Copper has been on absolute fire. A 2% decline doesn't even do that much to dent the record rally it's been on. And we're also looking at the pound taking a dip as well. Cable off today versus the dollar. The dollar is very strong. That's the one thing that was able to get a bid in yesterday's bloodbath of trading. That's continuing. But we are looking at the more risky currencies and commodity-tied currencies trading weaker in today's session, Anna.
Really interesting, and you mentioned what's going on with the Bund there. Danny, thank you very much. Danny Berger with them on the markets. You mentioned what's happening with the Bund. We are seeing buying of treasuries. We're seeing buying of Bunds as we try to turn a page on that higher yield story that had been so dominant, of course. We see Bunds moving then with treasuries. Is that because of the lines we've been hearing, the worries we've been hearing from the ECB and the expression of we can do more to limit the gains in yields, or is it just because of the treasuries move? Interesting to keep an eye on the European side of this story. Let's get a Bloomberg Business Flash. Here's Laura Wright.
Thanks, Anna. Airbnb's quarterly revenue is blitzing expectations as the firm benefits from travelers choosing vacation rentals rather than hotels. The company isn't giving a financial forecast and is cautious about 2021. Its stock is up over 160% since its blockbuster IPO late last year, giving it a valuation of more than $100 billion. And following on from that technology recovery, which Danny was just referring to, TikTok is agreeing to pay $92 million to settle privacy lawsuits that claim the app illegally recorded facial scans of its users and shared private data with third parties. In addition, the deal requires TikTok to initiate a new privacy compliance training program. The agreement still has to be approved by a Chicago judge. Twitter's unveiling the first details of its subscription model. It will let users charge for access to exclusive content to allow high-profile users to make money on the social network. These so-called super follows will likely come out sometime this year. It's part of Twitter's effort to open up new sources of revenue. That's your Bloomberg Business Flash. Anna.
Laura, thank you. Laura Wright here in London with your Business Flash. Coming up on the programme, 49 minutes, let's call it 50 minutes into the European trading day. We take a look at the big moves in the markets. It's been an exhausting morning already. We are off our session lows, though. The FTSE 100 paring back those earlier losses. Stocks 600 here in Europe now down by just 0.5% after being down by far more than 1% in the earlier part of the session. US futures now point higher. This is Bloomberg.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Welcome back to the European Market Open. 53 minutes into your European trading session, and stocks in Europe, yes, they're negative, but they're not as negative as they were. The FTSE 100 now only down, and the DAX only down by 0.2%. So the global stock sell-off is easing. That after the global bond sell-off eased. So markets have been digesting the spike in yields and the impact across asset classes. Here's what we've heard from some of our guests.
This is the bond market essentially telling us that a boom is coming in real growth in the country, and we're not priced properly in the rates market.
Rates are relative to the world, and we must consider Japan and Germany cannot be at 0 and the U.S. go to 6%.
We're selling off because of optimism for growth. And I don't think it's concern as much of inflation as much as it's concern that the Fed may not thread this needle.
Some of what we're seeing right now is more of a short-lived play, and that a longer-term risk on sentiment is still there underlying the markets and will still allow equity markets to trend higher.
This is a volatility amplified a bit by the retail activities, but it's just part of the repricing in this type of market cycle. And we think investors should be able to patiently look through this.
We are very close to the end of this, and I think it suggests real opportunities in some of the segments of the market that have been hit the hardest over the last week or so.
some of the voices that we've been hearing on this subject. And joining us now, Eddie van der Welt, our Markets Live editor. Eddie, it sort of stood out to me, that collection of sound bites there that we put together over the last 24 hours or so, coming before we saw stability in bond markets this morning. Most people, some sounding alarmed, but many of those voices sounding quite relaxed about what we were seeing, thinking it would be temporary. Is it over, I suppose, is my question.
Yeah, look, I think you were exactly right earlier in saying that this started in the bond market, and the bond market was the first to ease this morning. Bunds were the first to sort of catch a little bit of a bid early on in the session. Just calmed things a little bit. It is Friday, and I think nobody wants to put on a big position before the weekend and, make big portfolio allocations before the weekend. But saying that this is all over, I think it's too soon. Traders have been, have been conditioned to buy the dip, but this dip feels a little bit scary. So we'll see. We'll see towards the end of the session. For now, though, things have calmed down.
For now, things have calmed down. Take a breather for this stage of your Friday. What does this mean for Europe, though? I was talking to Ian Steely a little earlier on in the programme, and he was saying perhaps this is more alarming for Europe because we don't have the growth story to go along with the excitement in the yields that we see in the United States. And we've seen Philip Lane pushing back against higher yields. We've seen Isabel Schnabel pushing back against higher yields. And we have seen movement in the Bund, as you suggest.
Yeah, there's this great quote from a Clinton advisor from a few years back who said that if he comes back, from the dead someday, he wants to come back. If he's reincarnated, he wants to be reincarnated as the bond market because the bond market scares absolutely everybody. And I think we've seen that here, and I think it's doubly true for Europe, right? Europe is still struggling with poor vaccinations, low vaccination rates compared to other places. And it doesn't have the growth story, as you said. So if we see that, that spike in yields, I think Europe will be, the epicenter of the sell-off.
Okay, we're all a little bit scared by the bond market. Eddie, thank you very much. Eddie van der Welt, our Markets Live editor. Even if the bond market not looking quite as scary in terms of the pace of the moves this morning as it did the last couple of days. That is it for a busy European market open. Surveillance Early Edition is up next.
We have a very good chance to not only have positive growth, but perhaps a somewhat more encouraging positive growth.
The rebound in the second and third quarter will be quite strong because the expectation is that the vaccine will help clear the way to less restrictive lockdown.
We are going to have a recovery, but it's going to be an uneven recovery.
Of course, it will have direct impact on our growth forecast. And it will be very difficult to reach 6% of growth.
You're going to get a roaring 20s type of recovery and a boom period.
We are certainly seeing ourselves towards the second quarter being almost opening the economy as much as one can.
We should not be too quick to cut back on the expansionary fiscal policy.
We'll get there. The question is not a question of if, it's a question of more when.
this is the 1980s all over again, to make sure that we keep our hands firmly on the driving wheel.
I do not see demand coming back to the pre-COVID level anywhere earlier than the end of 2022.
If that happens and we see a demand recovery, then I think the market can absorb it.
Look what's happening to bonds right now. That asset class has done its thing. What's next?
The overwhelming majority of what is manufactured in the EU is actually going to EU supply.
The agreement that we have with China is the agreement that we have, and there are promises that China made that China needs to deliver on.
This is Bloomberg Surveillance, early edition with Francine Lacqua.
Good morning, everyone, and welcome to Bloomberg Surveillance Friday, the early edition this Friday, 26th of February. I'm Francine Lacqua here in London, and here's what's coming up on the program. U.S. benchmark yields hit 1.6%, wreaking havoc on the markets. Central bankers take action, with the ECB saying additional support may be necessary. Global stocks turn sour, Asian equities sink, and European equities fall, deeper in the red after a day of heavy losses on Wall Street. But one corner of the market shows resilience. GameStop closes up 142% over 2 days. Will retail investors be caught holding the bag? Well, good morning, everyone. It's really all about the markets this morning with some pretty wild moves we saw yesterday. The sell-off in bonds now easing, but there's no such reprieve for equities. Now, European stocks are following the Asian session deep into the red after the Nasdaq wiped off $500 billion from its combined market cap. Yields on the 10-year U.S. Treasury yield briefly rose above 1.6%, and that really triggered chaos on the markets. Well, here's how our guests reacted.
This is the bond market essentially telling us that a boom is coming in real growth in the country, and we're not priced properly in the rates market.
Rates are relative to the world, and we must consider Japan and Germany cannot be at zero and the U.S. go to 6%.
We're selling off because of optimism for growth. And I don't think it's concern as much of inflation as much as it's concern that the Fed may not thread this needle.
Some of what we're seeing right now is more of a short-lived play, and that a longer-term risk on sentiment is still there underlying the markets and will still allow equity markets to trend higher.
This is a volatility amplified a bit by the retail activities, but it's just part of the repricing in this type of market cycle. And we think investors should be able to patiently look through this.
We are very close to the end of this, and I think it suggests real opportunities in some of the segments of the market that have been hit the hardest over the last week or so.
Well, let's get more with our markets reporter, Danny Berger. Danny, the million, trillion, quadrillion dollar question today is whether, that bond rat run its course or whether stocks still need to fall a little bit further to go to, relative value where you want to get in again.
Yeah, it's so true. And I think really looking at the past chaos for the 12 past hours, and I think chaos might even be an understatement, it really is about how do you cope with that going forward. Even if we don't have a lot of volatility today from the Treasury market, was yesterday enough to continue to spook market players? Well, to one degree, we are seeing a lot of risk assets not perform so well. And I take you to the commodities column on the GMM. Everything here is in the red. Yes, you might see some of the bond space coming back, but looking at oil is off, WTI dipping below $63. We look at copper, that's still off. And that is why we're still seeing an impact in the European trading session. Equity indexes mostly in the red, especially some of the more cyclical names, ones that are in the DAX, for example, miners, anything that has to do with that commodity column. And same when it comes to currencies. The dollar is firmly in the green, meaning that a lot of these currencies are in the red. So, okay, perhaps some of it has eased, but are we in the clear? Are people ready to step away from panic mode? It's really hard to see it clearing up, at least for the next few hours, Francine.
Yeah, so I mean, is there a pain threshold, Danny? I know it's difficult. You know, is there at some point does that just become too much? I mean, at the moment, if you look at some of the markets, they're pricing in a Fed move for December 2022, which seems to be around the corner.
Yeah, that's certainly true. And I think in terms of thresholds, when do you go in and buy? I think there are a lot of people who want to put money to work. There's so much money on the sidelines that it's not unusual to see some of the dip buying. But pain is still there, Francine, especially when we look at what's leading the declines in terms of the U.S. future session. It's small caps. That it's about something completely different. And if you think this sell-off was happening because the economy was getting better, inflation was picking up, then it doesn't make a lot of sense to have these sell off. But
are you looking to sell Japanese yen? It's time. I'm placing an order to sell Japanese yen at 106, 120. 106, 120. Order placed. So if you want to sell Japanese yen right now, here is your time. You can follow this trade because we received the signal. Oops, position opened. The Japanese yen. Short position. I'll speak to you later, guys.
He said was, guys, prices are going up, but the economy is not overheating yet. Danny Berger, thank you so much with all of those wild market moves. Now let's bring in Laura Cooper, our Markets Live macro strategist, into the conversation. Laura, I don't want to ask you about what exactly happened yesterday, but if you look at the magnitude of the moves, what does it tell us about what could come next?
Well, certainly, I think, rates markets had to reprice just this robust U.S. growth expectations. They hadn't really kind of anticipated that fully yet. But I think what was most interesting about the moves yesterday was what went from a bear steepening in the curve on those upbeat growth prospects to that bear flattening, which is a warning flag for risk assets because it essentially indicates that markets were aggressively repricing for Fed tightening. And I think that does pose quite a challenge going forward for the Fed, just because their credibility is on the line. So as of now, Powell, we had Kaplan yesterday, not to raise rates until they reach that full employment mandate, until they get inflation much hotter, which they don't see for potentially several years. Whereas markets are telling us, no, they're calling the Fed's bluff. They expect that next year. So I think it'll be really interesting to see how this tug of war plays out and whether the Fed will have to do another head fake and really capitulate to markets in shifting their tone.
Laura, why did it happen yesterday and not the day before? Was it something that actually triggered the initial sell-off?
Well, I think, certainly we did have, maybe the markets questioning this positive outlook from the Fed. There wasn't really necessarily a catalyst to it, but I think the sell-off got to such a point where it became self-perpetuating. So it forced liquidation of some positions that in turn drove yields even higher, which then forced even more positions. So I think really at that point, it became to such an extent that we saw these moves that were unprecedented. I mean, we did have that 7-year auction that did have that record tail. So clearly there was some fragility in terms of bond appetite. So potentially that aggravated the move. But I think altogether it was just quite an exceptional day that may not likely to be repeated. But again, we'll see what happens when U.S. traders come in.
So, Laura, I want to ask you about some of the central banks in a second. But first of all, in terms of stocks, do they have, what's relative value looking like? How difficult is it to see, just given some of the technical aspects, whether they could fall further from these levels?
Well, I certainly think, up until about yesterday afternoon in the U.S. session, it did look to be like a relatively healthy correction and one that you would expect on reflation expectations. So tech was coming under pressure on account of those higher yields, where we were seeing financials and energy bid. Now, the challenge was that vulnerability in stocks did see the spillover as this contagious effect into those cyclical stocks. So I think what's likely to be the case, if we do see yields kind of ease off from their route, is we're going to see a resumption of that trade, because ultimately the fundamentals have not changed. The U.S. fiscal impulse is going to be quite strong. Central banks ideally want to keep accommodative conditions accommodative, and so that will continue to support that cyclical trade.
So will financial conditions, Laura, deteriorate if this happens again, or if this goes on, even if it's more moderate? And will it force central banks to step in?
Absolutely, and I think that is something that we're potentially seeing from the ECB. So yes, financial conditions remain exceptionally loose across the continent, and we are having central bank speakers come out saying that they have the ammunition if you step in. And it did seem to be the case yesterday that they were standing on the sidelines, whereas this morning, just this relative calm that we're seeing across European government bonds. I mean, German bonds opened up quite a bit on heavy volumes. So that does signal that perhaps we are seeing this invisible hand of the ECB stepping into markets. And it's something that certainly other central bankers abroad, like the RBA, are trying to do as well, trying to just calm this rise in yields, because ultimately their growth prospects don't reflect just the upbeat, kind of robust optimism that's captured in the U.S., because the fiscal impulse and the vaccine rollouts are quite different.
Laura, thanks so much. Laura Cooper, there are Markets Live macro strategist. Now, coming up, the bond market moderates, but equities really continue their swoon. We'll talk inflation next with RBC Europe's Peter Shafrick. That's coming up shortly, and this is Bloomberg.
Women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
When we look at women leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women had a very clear objective. They wanted to save lives.
The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected as leaders, whereas this doesn't hold true for men.
We need to get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
Let's just start with the numbers.
It would be essentially free cash flow positive in 2021. That was sooner than people had been expecting.
We have pretty good numbers here in the biggest divisions of Morgan Stanley. They are firing on all cylinders.
We've had this huge rivalry historically between Morgan Stanley and Goldman Sachs.
There are 24 reasons for Mr. Diamond to celebrate today.
As much as people may want to focus on trading, for Bank of America, it's all about credit.
It seems the markets are very happy with Trump. They're very happy with Biden.
Finance, politics. This is Bloomberg Surveillance, early edition. I'm Francine Lacqua here in London. Let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. EU leaders are closer to establishing a joint vaccine passport to enable countries to reopen travel. Commission President Ursula von der Leyen is urging them to hurry up, warning that Apple and Google may step into the vacuum with their own solutions. There is broad support for a vaccine certificate of some sort, but no agreement on what type of privileges it would actually grant. Now, a U.S. intelligence report is expected to say that Saudi Arabia's Crown Prince approved the killing of Washington Post columnist Jamal Khashoggi. A source tells Bloomberg it may be declassified as soon as today. The prince has denied any involvement, but says he accepts symbolic responsibility as the country's de facto ruler. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 20 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. Now let's get back to our top story. And stock markets have sold off from Wall Street to London as a spike in yields saw the 10-year Treasury top 1.6%. Well, here's a picture for European markets. The stock 600, you can see, I mean, we're seeing off the gains or off the wild moves that we saw yesterday, but it's very clear that markets now need to understand whether it's a time to buy or whether there's a little bit more to go in the bond round. The 10-year German bond, you can see minus 0.2 and euro dollar 121.41. Now let's bring in Peter Shafrick. He's RBC Capital Markets Global Macro Strategist. Peter, what a day to speak to you. I know we're both on like espresso number 7 or 8, given the last 18 hours. How does it translate into what the European Central Bank could do? They're looking at financial conditions. Does, the route yesterday actually affect them?
Well, yes and no, of course. On the one hand, it certainly does affect that, and we had various ECB speakers that have talked to the absolute level of yields. Spread levels, however, which is another big thing, particularly for us in Europe over here, have not really widened all that much. So I think in Europe, the situation is relatively calm, but obviously the ECB cannot be satisfied with particularly the sell-off that we've seen in shorter dated maturities yesterday, because one of the things that they have said, along with all the other central banks, is that they're going to keep rates low for a very long period of time, and the market is challenging that to some degree.
Peter, I want to bring you to actually, what we heard from the ECB board member Isabel Schnabel, and this is exactly what she says. A rise in real long-term rates at the early stages of the recovery may withdraw vital policy support too early and too abruptly. Now, policy will then have to step up its level of support. If you're a central banker right now, how difficult is it to understand how much the markets will test you? If you look at even what the Fed did, I mean, we had 2 days of testimony from Powell, and the markets just turned around and said, actually, we kind of believe you, but not really.
Yeah, let me quickly, before I answer your question, zoom in on one very crucial thing in that quote that you just put up: real long-term interest rates. Because when you see the market's behavior changed round about 2 weeks ago, whereas in the most of the time, basically since December, the market's increase in bond yields that we've seen was driven by break-evens, by inflation expectations. And I think that's essentially what the central banks want. They kept sitting there and nobody said a thing when bond yields were rising, when it was driven by inflation expectations. But about 2 weeks ago, we saw a radical change, and the increase that came afterwards was driven by real long-term interest rates. And that is, of course, what spooks central bankers. And then particularly yesterday, that extended not only into long-term bond yields, but into short-term bond yields, basically challenging the central bank's authority outright. So what can they do about it? So first of all, I think on the longer end of the curve, they can obviously increase their QE purchases or potentially buy longer duration assets, trying to push down on these levels. And particularly over here in Europe, and we haven't really seen that, but as I was alluding to, another big angle for the ECB, of course, is spread markets, and they can sort of time that into various markets where they feel the need. But at the shorter end of the curve, I think it's not necessarily only the buying that they can do. They have to communicate to the market very, very strongly that they want to live up to their promise to keep rates for a very long period of time, whatever that is. And then we'll have to see whether the market buys it.
Yeah, but haven't they done that? Certainly Fed, I mean, I listened to the whole testimony. Powell was pretty convincing.
Yes, of course, but you know that particularly on the FOMC, there's also a few dissenting voices. And when you look at even other central banks, and we heard earlier from your colleague Laura, she was citing Australia, which I think is a very, very interesting case, where you see that almost to the point where the central bank is buying in the yield curve control, the yields are under control, but then the second or the next bond on the curve is already spiking higher. So you have to, on the one hand, see them promising very strongly, but then also putting action to it in the case where they're buying bonds. And I think that's essentially what they have to do. They have to show the market that they're serious about this.
Okay, do you believe the markets, Peter? Are you with the markets, or are you with, what we heard from Jay Powell? The market is now pricing in a rate increase December 2022.
Yeah. So, I mean, in the US, we have to be a bit more careful because the dynamics in terms of inflation as well as in the labor market can be, let's put it mildly, much more, much better than they could be in Europe. So we'll have to see about that. In Europe, I'm very, very convinced that it will take a very long period of time before inflation reaches levels that the ECB will feel comfortable with. And I have much more faith that the ECB can defend the front end than that the Fed can, or that the Fed will.
Great. Thank you so much, Peter, for all of your insight. Peter Schaffner, RBC Capital Markets Global Macro Strategist. And one of the things that we were talking about with Peter is, of course, financial conditions. And Philip Lane also weighing in on that, the chief economist of the European Central Bank. So we'll bring you more of his comments throughout the program. Now, Kathy Wood says bonds have done their job. She says it's time to move on to crypto. Up next, we analyze the ARC chief executive's comments. This is Bloomberg.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Are you IPOing anytime soon?
Yeah, not this year. We'll see about next year.
Well, that was a Kraken chief executive, Jesse Powell, speaking on this program earlier this week. And this morning, Bloomberg also is reporting that the crypto firm is seeking new funding that would value it at over $10 billion. Now, we've learned that Europe's largest crypto exchange is in talks with Fidelity, Tribe Capital, and General Atlantic. The report comes as attention on crypto as an asset class is, of course, soaring. Now, at the same time, Bitcoin falling today after high-flying assets took a hit during the bond market rout. Let's get more with our markets reporter, Danny Berger. Danny, Bitcoin still off despite tech futures actually coming back.
Yeah, that's right. This asset not getting a bid while the rest of some of the riskier ones are. So S&P, NASDAQ now firmly in the green, but Bitcoin now is acting a lot more like some of the risky commodities out there. So I've put copper on here. Bitcoin is falling more. Of course, it's more volatile than copper, so that's not necessarily surprising. But I think the interesting thing, watching Bitcoin fall during this market rout, a lot of people had looked at the cryptocurrency and said, hey, perhaps this is a bet that it will protect us in the future against inflation. Well, that didn't exactly play out. At least it wasn't the haven that investors looked for when they were trying to protect themselves against losses in these markets. And one of the things we have to keep in mind is as more institutional players start to buy Bitcoin, if there's any sort of fire sale, that increased diversification means that people are also going to be selling off Bitcoin if they're getting hit in the bond portion of their portfolio or the equity portion. It's this kind of diversification effect when you need to find cash. Now, that might have been yesterday's action, but Cathie Wood, speaking to Bloomberg earlier, that's of course the ARK CEO, said that Bitcoin was a place that you should be going. Let's take a listen to that.
Look what's happening to bonds right now. Talk about the need for diversification here. If we are ending a 40-year secular decline in interest rates and are even just flattening out or moving up slightly, that asset class has done its thing. What's next? And we think crypto could be the solution there.
Francine, even though that didn't play out today, I should say there is evidence that institutions highly involved in this market, Coinbase filing yesterday in the U.S., saying that easily over 50% of the assets in Bitcoin are institutional.
Yeah, it's amazing, right? I mean, are we going to have a lot of IPOs, Danny, and things like that? It just seems valuations are just so high. We need 1 hour just to talk about Bitcoin. Our Danny Berger there with the very latest on all of the market moves. Now, can the man who pushed for the first Scottish independence referendum prevent a second one? We'll discuss that next. We speak with Camilla Cavendish. This is Bloomberg.
These solar arrays that we're going to install are going to be about half the size of the existing solar arrays that we have on the International Space Station. But because of the advances in technology over the years, they're going to provide about twice the power in just half of the area that the existing solar arrays cover.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com webinars.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
U.S. benchmark yields hit 1.6%, wreaking havoc in the markets. Central bankers take action, with the ECB saying additional support may be necessary. Global stocks turn sour. Asian equities sink and European falls deeper in the red after a day of heavy losses on Wall Street. But one corner of the market shows resilience. GameStop extends its surge, up as much as 10% in pre-market trade. Will retail investors be caught holding the bag? Well, good morning, everyone, and welcome to Bloomberg Surveillance, the early edition. I'm Francine Lacquet here in London. Now, it's all about the mayhem in the bond markets and, of course, a read across to equities this morning. First, here's how our guests have reacted to the market action.
This is the bond market essentially telling us that a boom is coming in real growth in the country, and we're not priced properly in the rates market.
Rates are relative to the world, and we must consider Japan and Germany cannot be at zero and the U.S. go to 6%.
We're selling off because of optimism for growth. And I don't think it's concern as much of inflation as much as it's concern that the Fed may not thread this needle.
Some of what we're seeing right now is more of a short-lived play, and that a longer-term risk on sentiment is still there underlying the markets and will still allow equity markets to trend higher.
This is a volatility amplified a bit by the retail activities, but it's just part of the repricing in this type of market cycle. And we think investors should be able to patiently look through this.
We are very close to the end of this, and I think it suggests real opportunities in some of the segments of the market that have been hit the hardest over the last week or so.
Now let's check on the markets. Now, the global bond market really attempted to a bit more normality. It's attempting to recover from this aggressive sell-off that really drove some of the steep losses in treasuries and U.S. stocks on Thursday. Now, the 10-year treasury yield falling back below 1.5% after trading as high as 1.6%. But again, yields on core European bonds have actually ticked lower. And you can see for example, NASDAQ futures now pretty much flat, but at least we're seeing a bit of green after the sea of red that we saw yesterday. Now let's get straight to the Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Airbnb's quarterly revenue is blitzing expectations as the firm benefits from travelers choosing holiday rentals rather than hotels. The company isn't giving a financial forecast and is cautious about 2021. Its stock is up over 160% since its blockbuster IPO late last year, giving it a valuation of more than $100 billion. Now, TikTok is agreeing to pay $92 million to settle privacy lawsuits that claim the app illegally recorded facial scans of its users and shared private data with third parties. In addition, the deal requires TikTok to initiate a new privacy compliance training program. The agreement still has to be approved by a Chicago judge. And Twitter is unveiling the first details of its subscription model. It will let users charge for access to exclusive content to allow high-profile users to make money on the social network. These so-called super follows will likely come out sometime this year. It is part of Twitter's efforts to open up new sources of revenue. And that's your Bloomberg Business Flash. Francine.
Leanne, thank you so much. Now, our next guest wrote in the Financial Times that the only thing that could derail Nicola Sturgeon's hope of a second Scottish referendum would be this particular inquiry. Joining us now is Camilla Cavendish, former head of Prime Minister David Cameron's policy unit and an advisor at the UK Department of Health and Social Care, and frankly, one of my favorite thinkers when it comes to all things UK. So thank you so much, Camilla Cavendish, for joining us today. First of all, what's the right way for the Prime Minister to deal with Scotland now?
Well,
A lot of people would like him to introduce a kind of proper federal union, almost like the US. I actually personally think we've had years and years of just sort of mission creep and giving in. And I think actually what he needs to do is have a new act of union where he says, we're not going to have a second referendum. We agreed that the last one would be for a generation, but we're going to have a new act of union where we say the UK is a unitary state, but within that model, we decide which powers to devolve. And I think he can call Nicola Sturgeon's bluff, but he is, of course, tremendously unpopular in Scotland. And a lot will depend on the inquiry you mentioned, which may derail Sturgeon herself.
Yeah, so what are the chances that actually, she gets derailed? This is one of the main topics that we're trying to figure out. What happens after Nicola Sturgeon if she's no longer in charge?
It's a very interesting question. I mean, most of the attention, of course, is on COVID and a bit on Brexit, but the sort of torturous conversations within the Scottish Nationalist Party have largely been overlooked. But the truth is that there are two factions in that party, those who supported Alex Salmond and believed that actually Nicola Sturgeon did not treat the complaints against him properly. And there is a deep split in that party, which is hoping to win a majority in May. But it's not completely certain. And if she does have to resign, it's not a fait accompli.
Camilla, when you look at, the Prime Minister has had quite a year. I mean, he also caught COVID himself. Now the vaccinations seem to be going okay. What should his priorities be? Is it really the North-South divide? Is it what to do with taxes and raising? Is it how, post-Brexit? Like, there's so much going on. What should he actually be prioritizing?
Well, he's had a terrible year. I mean, the UK has passed 100,000 deaths and our economy has taken a real hit, as you know. The vaccine rollout has been a tremendous success. And of course, now the Prime Minister's political capital has risen as a result of that. He has a very ambitious agenda. I mean, he wants to lead the COP26 climate summit and use that as a way to rebuild relationships with the White House. He has a whole raft of other policies. The budget, we have a budget on Wednesday where, of course, the big debate is about whether to raise taxes or which taxes to raise. And there's a very unlikely alliance between the Labour Party and a lot of Conservative backbenchers saying to the Prime Minister, don't raise any taxes, don't raise corporation tax. Actually, I expect that corporation tax will be raised. Partly because they expect that it will still not go to the highest level in Europe and that Biden himself will raise corporation tax, so we will still be competitive. And I actually do think, we're going to have to find some ways of paying for the £300 billion bill, depending, as you said earlier, on what happens with borrowing rates. But the Prime Minister's big priority is levelling up the North-South divide. And one of the things the pandemic has shown, I think, is just how deep the inequalities are in this country, how deep the health inequalities are. Life expectancies are dramatically different in different parts of the country. And a lot of people in the South have seen people in the North and other areas, poorer regions, really suffering. And I think there's a lot more public awareness now, not just that we need to level up on moral grounds, but also that productivity really needs a boost. I mean, among G20 countries, there is no country richer than the UK, which it has such an unbalanced regional economy. And so there is a huge dividend to gain if they can find a long-term plan for growth which addresses some of those divides.
But Camilla, on the budget, you don't think it's too soon to actually start cutting the deficit? Do you think this budget should be more about spending and supporting the economy in this very difficult transition?
I think it has to be mainly about supporting the transition. Also because, of course, Brexit, we're still struggling with Brexit. I mean, the kind of bureaucracy that a lot of businesses are facing and the volatility in trading and some of the difficulties still with many service industries where, Brussels has barely concluded any of the agreements that we need, means we really do need the government to keep spending, in my view. But I do think they need to rip up some of their manifesto. I mean, the Conservative government came in just before COVID with a big spending manifesto. They wanted to spend a lot of money on infrastructure. They wanted to preserve a lot of the benefits to elderly pensioners, which, to be quite honest, I think they need to review now, because especially the tipping between the generations that we've seen in this crisis, The old have obviously been more vulnerable to the disease, but the young are the people who are going to have to take the economic hit. And I think they do need to change some of their manifesto commitments on that.
But, so what would be the right policy mix to, I guess, protect jobs, but also stimulate employment?
Well, they've got a number of policies already to try and retrain and reskill people. If they could increase capital allowances, I think that would make a big difference, especially to some of the poorer manufacturing areas that have been really hard hit. And I'd also actually think that tax simplification would be significant. I think they need to do something very creative. They need to go back to the sort of Thatcher era of enterprise zones and start looking at tax breaks, start looking at how they can put more money into R&D and build partnerships, public-private partnerships with business. I mean, what we've seen in the vaccine creations has been really effective public-private partnerships, and I think we need to use that as a model going forward.
Thank you so much. Camilla Cavendish, their former head of UK Prime Minister David Cameron's policy unit, and of course, UK Department of Health and Social Care advisor. I love Camilla's column, so I urge everyone to go and check them out. And also, she had a great book out in 2019. Now, back to the markets, because it was a pretty wild ride over the last 18 months. So let's look at what global bond markets are doing now. They seem to be attempting to recover from this aggressive sell-off that drove steep losses in treasuries and U.S. stocks yesterday. We're seeing a little bit of red, but again, it's actually very timid. I'm looking at the 10-year yield falling back below 1.5% after trading as high as 1.6% on Thursday. I'm losing my voice because I probably was shouting too much in the market route. Now, coming up, we speak to George Saravelos, Deutsche Bank Global Head of FX Research, who explains to us why he's turning bullish on euro-dollar again. This is Bloomberg.
Generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
The past 10 years have seen the rise of names like Siri and Alexa, EVs like Tesla's Model S, wearables like the Apple Watch. What will the next decade bring? Catch a special edition of Bloomberg Technology, 10 years of innovation on Bloomberg Television.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Let's get straight back to the markets. Joining us now is George Saravelos, Deutsche Bank Global Head of FX Research, who thinks it's time to sell the dollar and buy the euro again. So, George, first of all, thank you so much for joining us. I have like 1,000,001 questions about what happened yesterday. But first of all, talk to us about that bold new call.
Thank you, Francine. Good morning. I think it is important to put things in context of what happened yesterday. And if you look at the moves, a couple of observations. The first one is it was really a global attack on fixed income. So it wasn't just the US. You had huge moves in other countries, most notable, for example, Australia, New Zealand. And I think the key difference from previous weeks is that we saw a concerted market attack, so to speak, on central bank credibility and on the front end of rates, as in the pace of rate hikes for the next 1 or 2 years. I think that's precisely the reason now we should see central banks provide a lot more pushback and actual intervention in terms of buying to prevent some of that pricing taking place. But I guess that's where it fits in with our updated euro-dollar view. And the argument is, if you look at what's priced into the US now, for example, we're pricing peak exceptionalism. You have priced a rate hike next year for the Fed, and I think it's going to be much more difficult now to add to that pricing as we go forward.
But George, are you expecting a Fed hike in December 2022 like the market is, or is it a little bit too soon, given also the testimony that we had for Powell, Monday and Tuesday of this week?
So I think that's the crux of the question, Francine. And if you look at the Fed's communication, even from a practical perspective, it's going to be extremely difficult for a rate hike to take place next year, because if the Fed was to announce a taper, it would take about a year for that to materialize, meaning it would run well through into next year. So I think one reason we were cautious on arguing for a weaker dollar to start the year was that the market could start pricing more rate hikes. But I think that has now happened, and we're probably approaching the peak of market pricing. And that's one reason behind turning more positive on the euro. A second reason is just the relative vaccination dynamics. So over the first 2 months of the year, the US was really picking up pace, but we think we're reaching an inflection point now where the European vaccination program will improve. So that news flow should start turning more positive for the euro. And then finally, you've priced in the Fed now. I think the big risk for the next 2 to 3 months is the market starts focusing on external dynamics, the deterioration in the trade deficit, big potential widening in the current account, and that would be a dollar negative as well.
But George, so it was interesting also to see your note earlier on saying that actually you think, the central banks are not impotent. What can they actually do? When you look, again, at the Powell testimony and the fact that the markets are really pushing back against it, the ECB also came out with some comments about financial conditions. What's the next step for central banks?
So it's a fascinating question. And Francine, I think the answer is very simple. So far we have had talk, and now is the time for action. And action is they just need to buy. So, for example, the RBA has a 3-year yield target. They need to come in and buy more aggressively, as I wrote yesterday evening. And that's what we have seen overnight, and that's pushed 3-year yields down. Similarly to the ECB, they have long emphasized flexibility of QE so they can increase the amounts. And we have to remember, even the Fed communicates QE in terms of lower bounds. So they say they can buy at least 120 billion, which means they could buy more. So I think apart from verbal guidance and communication, which we've already had, the next step is really action in the market.
But then does it make it more difficult to unwind?
Well, I think in the very front end, and that's what matters. If you look at up to last week, where the moves were driven by improvement in long-term inflation expectations, in long-term growth, central banks will be fine with that. The issue is more in the front end. And what you saw this week is the market pricing rate hikes, but inflation expectations going down at the same time, which is not consistent with central bank communication. So yes, I think they can buy more within the powers they have. And operationally or from an unwind perspective, I don't think that will provide any sort of difficulty.
George, earlier the ECB executive board member, Isabel Schnabel, basically said that the central bank may have to take further action. Here she is.
A rise in real long-term rates at the early stages of the recovery, even if reflecting improved growth prospects, may withdraw vital policy support too early and too abruptly, given the still fragile state of the economy. Policy will then have to step up its level of support.
So given, George Serravallis, that you're turning bullish on euro-dollar, do you have a price target, or, how does that change actually, the dynamics you're seeing in that pairing from now until the end of the year?
So 125 is our forecast for the middle of the year, Francine. I think for the market to get going again, we just need to see this fixed income, what I call VAR shock, volatility shock, stabilize, because at the moment the market is being disrupted by these moves. But I do think 125 is achievable. One last comment I would make on this Schnabel piece you highlighted. It's a very big difference to the 2013 taper tantrum as well as the 1994 bond sell-off. We have to remember back then, central banks, the Fed was hiking in 94, and the Fed signaled taper in 2013. This is an environment where central banks are pointing the other way, and I think that's just a key difference and should help stabilize things quicker compared to previous years.
George, thanks so much. Always great to have you on Bloomberg Surveillance. George Serravallis, Deutsche Bank Global Head of FX Research. Now, coming up, Bitcoin heads for its biggest weekly loss in a year as high-flying assets take a hit from the bond market rout. We take a look at some of the big market movers. This is Bloomberg.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, the sell-off in bonds has eased. There's no such reprieve for equities, though. European stocks starting the morning in the red after the Nasdaq wiped out $500 billion from its combined markets. Danny has been all over this for the last 18 hours. I don't even know, Danny, if you've had any sleep, but actually, you know, the markets are a little bit calmer today.
Francine, the markets don't sleep. You and I don't either, fueled purely off of caffeine. I have to say, though, one sort of thing that is perhaps brightening things up as we get further along in the day is, yes, there's a lot of red here, but this is a more positive picture than when we first came in the morning. And a lot of it has to do with this column right here, sovereign bonds turning into the green, people stepping back in and buying the bond sell-off. So that means if the concern, the initial equity damage was because yields was too high or that move was too fast, bond yields coming back down is aiding a more calm picture. So you can see Euro stocks off 0.5%. Given the turmoil we saw yesterday, that's not too much of a hit.
Danny, Bitcoin.
That's not too much of a hit.
Danny, Bitcoin still off despite tech futures coming back.
Yeah, I mean, look, if you want Bitcoin to be a diversifying asset, it wasn't yesterday, it was off, and kind of a weird twist of fate. I guess it's diversifying today because U.S. futures are coming back, but it's still in the red. Definitely acting more like a commodity at this point in time. There was some idea that would be an inflation hedge. It would be better than gold. Kathy Wood arguing this yesterday, that it's good for diversification. But I think the wide institutional adoption means that if there's a fire sale, a VAR shock, then perhaps Bitcoin is going to get hit in that picture as well.
Turmoil, I mean, it's come at a time when actually retail investors' participation is pretty high. Is there a danger that actually they really get caught in this turmoil and a lot of people save a lot of savings, Danny?
Yeah, definitely, because if you think about institutional investors using the high yields or at least higher yields as an opportunity to sell into a very richly priced market, what does that mean for retail investors who are still buying? Look at GameStop, pre-market up nearly 5.5%, and it was up yesterday. Hey, maybe Bitcoin isn't the diversifying asset. Maybe GameStop is the ultimate diversity asset at this moment. But I think that shows that there's still a lot of people in this market willing to go in and buy risky stocks, even on a day like yesterday that was chaotic. If you want to put it more harshly, you can say what Richard Haley from Awanda Corp said, that dumb money still wants to go in, still wants to buy. Some of the other retail favorites, Fran, though, Tesla, ARK, ETF, still in the red today after a pretty sizable sell-off yesterday.
Yeah, we need to talk about McDonald's on a number of levels. First about the McPlant, I didn't even know it existed, but also McDonald's. I mean, there's these memes with the McDonald's ice cream cone. Danny, yep. I know we need to talk about it, so we'll get you back on in the next hour. We'll have, of course, on Monday, the former Bank of England Governor Mervyn King. And next, more Bloomberg Surveillance.
their CPG history, their experience, and really how we might be able to combine together to really create this fantastic public company. And so we kind of got into the SPAC thing a little bit before it became such a hot method of going public.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Look what's happening to bonds right now. That asset class has done its thing. What's next?
The overwhelming majority of what is manufactured in the EU is actually going to EU supply.
The agreement that we have with China is the agreement that we have, and there are promises that China made that China needs to deliver on.
This is Bloomberg Surveillance, early edition, with Francine Lacqua, Matt Miller, and Keely Lines.
Well, good morning, everyone. From London and New York, this Friday, February 26th, I'm Francine Lacqua here in London. Kaylee Lines is in New York. Matt Miller recovering from the wild moves that we saw yesterday in the markets. Kaylee, I have to say it's been a pretty busy 18 hours. It's not only about the bond route, but I think markets now need to decide whether the bond route is over and they feel a bit more comfortable, or whether, if you look at the stocks, they need to decline further until they find the relative value where they're happy to go in again.
Yeah, I think that's the key question, Francine. The market really trying to digest all of this after what was a steep sell-off in the U.S. yesterday. The NASDAQ ending the day lower by 3.6%, worst day since October. We are seeing a bit of recovery, though, in U.S. futures, at least this morning. Those stocks are still lower in the European session right now. NASDAQ 100 futures are up by about 0.3%, Francine.
Yeah, Kaylee, I know you have a full roundup of the markets, and if you're a central bank today, and we hear it from a lot of market participants, it's like their credibility is at stake, and they either do something to convince the markets that they're there and, you know, they can do something, or actually they become, you know, impotent, I think is one of the words that one used in the earlier hour. What do you have for us on the markets, Kaylee?
Yeah, well, as I said, futures here in the U.S. have flipped into the green, though it is still a red session over in Europe. And we are off the lows, though. The Stock 600 now down just about 0.4%. What, of course, this market is digesting, Francine, as we were just discussing, is the tantrum that happened in the bond market. And I want to focus specifically on what happened in the belly of the curve. We don't usually focus so much on the 5-year Treasury note, but it was key yesterday. At one point, up 22 basis points. Now it's coming in a bit, but we're still sitting at 0.77% or so above that 0.75% threshold. That is a key, closely watched technical level for many in this market. Of course, there were a lot of factors here. It's not just about inflation expectations. You also had really low demand for the 7-year auction, some technical factors as well, unwinding of positions, convexity hedging on the part of investors in mortgage-backed securities. As mortgage rates went higher, they had to sell longer dated treasuries. So a lot going on, and we have to keep in mind, as you were saying, Francine, how the Fed factors into all of this, and traders are ramping up their expectations as to when the Fed is going to hike first. Now, according to Eurodollar futures, that hike is seen in the first quarter of 2023. That is re-rated forward from mid-2023, which was seen earlier this week, and early 2024, which is where we started the month. So traders now expecting the Fed is going to have to move a bit sooner than anticipated, Francine.
Yeah, what a wild ride that we've seen. Now, it does appear that certainly markets are stabilizing a little bit now, but here's what some of our guests had to say about the aggressive sell-off triggered by rising yields.
This is the bond market essentially telling us that a boom is coming in real growth in the country, and we're not priced properly in the rates market.
Rates are relative to the world, and we must consider Japan and Germany cannot be at 0 and the U.S. go to 6%.
We're selling off because of optimism for growth. And I don't think it's concern as much of inflation as much as it's concern that the Fed may not thread this needle.
Some of what we're seeing right now is more of a short-lived play, and that a longer-term risk on sentiment is still there underlying the markets and will still allow equity markets to trend higher.
This is a volatility amplified a bit by the retail activities, but it's just part of the repricing in this type of market cycle. And we think investors should be able to patiently look through this.
We are very close to the end of this, and I think it suggests real opportunities in some of the segments of the market that have been hit the hardest over the last week or so.
Now, to talk about all of this market route is Eddie van der Walt of Bloomberg MLive. Eddie, I know none of us have slept for like 18 hours just trying to figure out what was happening next, and we're all on espresso number 8 or 9. But what does, a route of that magnitude tell us about what's coming?
Yeah, absolutely. I got about 2 hours worth of sleep and dreamt about vampires and decided it's better to just get up and watch the market action. Listen, absolutely, your guests earlier were right. This is all about the bond yields ticking higher over the last few days. And this morning, what we really saw was we saw bonds coming back a little bit and the yield coming down a little bit in the early European session. And that just, put a little bit of calm back in the markets. But so much of this rally in equities have been driven by low interest rates that any tick higher will be what spooks markets from here on out.
Okay, so what does it mean for stocks, Eddie? So you have this, bond route and basically risk assets sell off. If you look at relative valuations, are stock markets looking attractive, or do they have further down to go?
I feel like, so two things. The discount rate on stocks was so low, particularly on those infinite maturity, tech shares and so on that don't pay dividends, that any rise in yields, any tightening in policy will be severely felt. So, when we look back at the taper tantrum in 2013, that was primarily a bond market event. But this time around, I think the tantrum of the taper will be felt more in equities.
Eddie, what's also really interesting is that this is, it's kind of started as a U.S. move, but it really went global. What does it tell us about the need for central bank resolve, almost, coordinated globally for this to be put to rest?
Yeah, there was a very good segment just before me from Danny Berger who talked about correlations, not spiking across all of the asset classes and some of them still acting as non-correlated. The fact that we haven't seen the correlation, all the correlations go up to 1 is significant and shows that this route, while significant, is not an event on the scale of March of last year. That said, gold came off along with equities, which is always something that worries me a little bit. So yes, but I think if we see a sell-off in the US, there's no way that the rest of the world is immune to that.
Well, Eddie, you mentioned gold, and I want to ask, it is not acting as any kind of inflation hedge right now. So what is? Where are people hedging?
Inflation hedging is a really hard thing, and we've heard the likes of Ray Dalio talking about diversifying, their portfolios into a broader range of assets. I don't buy the argument that Bitcoin is acting as an inflation hedge, because really there is no track record there. I think still I'd look at the defensive stocks. I'd look at utilities and that sort of thing. Utilities particularly attractive because of the EV play as well. We're going to use more electricity going forward. So that would be where I would be looking for inflation hedging.
Yeah, bond market proxy is actually faring a little bit better today in the European session as well. I want to ask, though, we focus so much on the nominal yield, but real yields in particular as well. The 10-year rate is now at the highest since June. At negative 66 basis points, is that a pain threshold where it is going to bite risk assets, or is that going to happen later on down the road?
Yeah, and the break-even rate as well, right? I think, we're seeing break-evens above 2% from the 1 year to the 10 years. So, nominal yields have picked up, but that's a natural progression of what people are expecting about, people's inflation expectations and growth expectations. So I don't think this is a big surprise, but I think the fallout could be significant.
Eddie, do financial conditions deteriorate because of these moves?
That is the risk, and that is what central bankers were trying to stem at the beginning of all of this back in March of last year. Was they didn't want an equity sell-off to spook people further, tighten financial conditions further. You do have to wonder, though, that if the real economy is starting to pick up, whether the central bankers will at that point just say, look, the equity market's going to do what it's going to do, and it's no longer a systemic risk for the market. So I kind of feel like perhaps we're not quite at that point yet, but I do think they're a little bit less worried about an equity sell-off than they were last March.
Eddie, when you look at some of the tech stocks, they're shy, they're still timid, but actually they're rising by a touch. Bitcoin's still down. What's going on?
Yeah, Bitcoin very technically driven at the moment. So look, I know a lot of people will roll their eyes at the technicals, but Bitcoin as a purely demand side asset is very much driven by the animal spirits. So it's not surprising to me that we've seen some pullback there. It's trending a little bit lower, but then again, the conditioning has been to buy the dip on everything. So perhaps we see Bitcoin come back later in the session too.
Eddie, thank you so much. I have so many questions also about retail investors and actually, if they caught up in the rout, what happens. Bloomberg's Eddie van der Laat there, our MLive guru. Now, coming up next, we continue looking at the markets and the bond market rout with Geraldine Sundstrom, PIMCO portfolio manager. She's up next, and this is Bloomberg.
We have a very good chance to not only have positive growth, but perhaps a somewhat more encouraging positive growth.
The rebound in the second and third quarter will be quite strong because the expectation is that the vaccine will help clear the way to less restrictive lockdown.
We are going to have a recovery, but it's going to be an uneven recovery.
Of course, it will have direct impact on our growth forecast. And it will be very difficult to reach 6% of growth.
You're going to get a roaring 20s type of recovery and a boom period.
We are certainly seeing ourselves towards the second quarter being in almost opening the economy as much as one can.
We should not be too quick to cut back on the expansionary fiscal policy.
We'll get there. The question is not a question of if, it's a question of more when.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons in New York with Francine Lacqua in London. Matt Miller is off today. Well, Francine, I want to continue this conversation about the tantrum in the bond market and the turmoil it has caused in other asset classes, specifically in equities and especially those that are very richly valued, the likes of big cap tech. And this is a great way to look at the relative value of stocks and bonds. What I'm looking at here is the global dividend yield for the MSCI All World Index relative to the yield on the 10-year Treasury. We can see how that has narrowed now to just about a third of 1 percentage point. That is how narrow it is. It's the tightest spread between the dividend yield on stocks and on the 10-year Treasury since going all the way back to 2019. And if you were to just look at the S&P 500's dividend yield relative to the 10-year yield has now surpassed that for the first time since 2019. So as all of this goes on, as Treasury yields are inching higher and higher, bonds are starting to look relatively a little bit more attractive, Francine.
Kaylee, thank you so much. Now let's get straight to Geraldine Sundstrom, PIMCO portfolio manager. Geraldine, so the market rout started yesterday. You have, of course, skin in the game because you're a portfolio manager. I mean, what's your first thought? Do you say, look, this has a lot to go, or this is a healthy correction?
Well, I would go with the healthy part. I think the market is pricing the fact that, vaccination rollout is surprising in a good way, that fiscal stimulus is also showing some upside. Earnings of companies have been very good, and the economy is probably not as bad as we thought. So overall, there has to be a repricing of, bond yields. We were in a rich level. Now we are entering an area that's probably closer to fair. But of course, when those moves occur, you get momentum, you have positionings, and things can get a little bit more hectic. That said, and I think central banks have been good in their messaging, policy is going to remain accommodative for a long time, and maybe the market is getting a little bit rushed into pricing hikes so soon on the calendar.
Geraldine, so I was going to go back to the basic and actually ask you about that, that rate hike. So there's part of the market that is actually expecting the Fed to hike rates, despite Jay Powell saying otherwise for 2 days in testimony, saying that they're expecting a rate hike in December of 2022. Do you expect that, or is it too soon?
Compared to our forecast, I would say it's a little soon relative to what we thought. It would be something that we would see probably into 2023 rather than 2022. So, markets can overshoot, go fast at times. It will take a while before we have a fair idea about, where inflation lands at the end of this year. There will be a spike, we know that. And this is like going on some raw nerves, probably. But ultimately, I think we're going to get a good rebound in the economy. This is positive for risky assets. And I would say the elasticity of this economic rebound to the actual level of yield is not as high as one can think. So I don't think it does change that dramatically the fundamental picture for risky assets.
Well, Geraldine, talking about the inflation outlook, Jerome Powell, in his testimony that Francine mentioned this week, he also said it could take up to 3 years to reach the Fed's inflation goal. Do you think it's actually going to take that long?
In our forecast, it's slightly earlier, but of course, there's a big interval of confidence around this forecast. We're really going through a period that's unprecedented for many of us. And I think, the market is trying to handicap all these scenarios, and that's leading to some volatility. We are going to get that spike in inflation globally. I mean, it's written on the wall. We have to look through this and see ultimately where this continues. But I think we think that secular forces remain deflationary, and there's no reason to think that inflation is going to run away in the medium term.
So does that mean you can hold sovereign debt in your portfolio? Can you touch government bonds with a 10-foot pole right now?
I think, government bonds belong to any multi-asset portfolio. And certainly now they are getting into a zone that is, getting more attractive. We're going to have to see in the next few weeks how this evolves and, where value start to arrive.
Geraldine, will the ECB buy more bonds, and does that change what you find attractive right now? Is there anything that you're scooping up?
Well, I think the ECB is proving a little bit more cautious relative to the Fed, and that's fairly understandable. The economic situation in Europe, the vaccine rollout, but also the strength of the euro, and even looking at earnings of companies. I mean, the earnings in Europe are still in deep negative territory, whereas in the US or Japan, they've already turned a corner and show good positive growth. So it's natural that Europe will have to have a messaging that is a little bit more careful. But at the moment, it's mostly words rather than action. We've seen some action in Australia. We'll see where the market wants to push this. I think at the moment they are wait and see.
Yeah, do you worry about, at the margins also retail investors being hurt? I mean, could it be the perfect storm in the next couple of weeks? Or do you think, once again, we started the interview and you said you're a bit more optimist about the future. What if it goes the other way?
Well, I think volatility is unpleasant for most investors, and sometimes retail can very, very momentum driven. I think ultimate outcome for portfolio, will have to be in, security selection and also having some hold power and being anchored around a macroeconomic framework. And from that standpoint, I think that there are no big reason to dramatically worry about risky assets when we look, towards the end of this year. So I think it's about picking and choosing the things where you have high confidence and hold through the storm.
Geraldine, thank you so much. Geraldine Sundstrom there of PIMCO. Now, coming up a little bit later today, the U.S. Transport Secretary, Pete Buttigieg, he joins Kevin Cirilli on Bloomberg Radio's Sound On. And also coming up on Monday, probably the interview of the week with JP Morgan Chase Chairman and Chief Executive Jamie Dimon, who'll sit down with us for an exclusive conversation. He'll be talking to our Ed Hammond for the JP Morgan 2021 Global High Yield and Leveraged Finance Conference. Catch that interview on Monday. This is Bloomberg.
Women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
When we look at women leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women had a very clear objective. They wanted to save lives.
The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected as leaders, whereas this doesn't hold true for men.
We need to get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
Surveillance. Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Extraordinary market day.
This rally just keeps on going.
But there is a tipping point.
The business team you love to watch. Weekday mornings on Bloomberg Television.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Farrow. This is Bloomberg Real Yield.
This is Bloomberg Surveillance, the early edition. I'm Francine Lacqua here in London, Katie Lyons in New York. Matt Miller off today. Now let's get straight to the Bloomberg First Word News, and congressional Democrats will have to find another way to get a $15 minimum wage approved. The Senate's parliamentarian has ruled they cannot use a fast-track budget procedure to make the change. They're already using that process to push through President Biden's $1.9 trillion coronavirus relief package. while progressives say the Democrats could ignore the ruling, but President Biden indicated that the White House will not do that. And President Biden has also undertaken his first overt use of military force since taking office. Now, the U.S. carried out airstrikes in eastern Syria. The targets were connected to Iran-backed groups believed to be involved in recent rocket attacks on U.S. forces in Iraq. The Pentagon says multiple facilities were destroyed. And Bloomberg's learned that a U.S. intelligence reports implicates Saudi Arabia's crown prince, Mohammed bin Salman, in approving the murder of Washington Post columnist Jamal Khashoggi. While the report could be declassified as early as today, that release reflects the Biden administration's decision to recalibrate relations with Saudi Arabia. Prince Mohammed has denied any involvement in the killing. And finally, the world's biggest Bitcoin fund is selling off faster than the cryptocurrency itself. Now, the $32 billion Grayscale Bitcoin Trust has plunged at 20% this week. Its premium to its underlying holdings has evaporated as a result, while Bloomberg Intelligence says what's happening in either panic or profit-taking selling. I mean, there's a lot going on with Bitcoin. This is like Matt Miller's first true love, so I'm a little bit disappointed that it's today that he's not on with us, Kaylee. But there are a couple of things. I was looking at Kraken. We spoke to the chief executive earlier on, and I think there's now a valuation that doubled over the last couple of months to $10 billion. This hasn't been confirmed, but it's with the people familiar with the story. And then Bitcoin cannot actually recover today. It could change very quickly, but after the sell-off yesterday.
Yeah, Bitcoin can always change very quickly, Francine. This is one of the most volatile assets that is out there, but it is actually heading for its worst week in about a year, and it does raise the question. A lot of people have talked about whether or not Bitcoin is a correlated asset, if it moves in tandem with broader risk sentiment, and at least this week, it does look like that could be a factor in what has put so much pressure on Bitcoin, the fact that we have seen such turmoil in broader risk markets, Francine.
Yeah, I think we spoke to Vijay Iyer, head of Asia Pacific for the cryptocurrency exchange Luna in Singapore, and he says, look, risk-on assets are taking a hit, and we're seeing stocks slide. Crypto is falling. Also, there are various memes about either McDonald's cones or actually, frogs, which I'm trying to get my head around, and we'll see if that has any market implications going forward, Kaylee.
Yeah, I don't know anything about the frog emoji, Francine, so I'm just gonna leave that one there. Interesting story.
Coming
Bitcoin.
up next,
Yay,
Simon French. Simon French, Panmure Gordon chief economist. I don't know whether he's on Reddit, but maybe there's a wider implication for some of the retail investors, and we'll also ask Simon about that. This is Bloomberg.
What's the biggest mistake you made when you were a fresh MBA grad and looking for a job?
Make sure you try to do something that you're interested in and that you think you'll be good at. I just was on a path to law school, and I actually never asked myself why I wanted to go to law school. And I randomly went to an investment banking analyst recruiting event, and I figured out I had an aptitude for it. I was interested in the work. If you're not interested in it, and it's not something you're good at, the money will not justify it. I also think that there's nothing wrong with experimenting. Doing something that you always thought you might want to do, or trying it for a couple of years, you can then go back down a traditional path if that's what you want to do. Try to remember what you want out of a job, where you want to live, what you want to get from it, from personal experiences, from development, from training, from fulfillment, from engagement in the community, and make sure you think about those things up front as you're recruiting and not try to evaluate it after you got there.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Bloomberg Surveillance, the early edition, and here are some of our top stories. The global bond round eases after yesterday's havoc. Will central bankers take action, with the ECB saying additional support may actually be needed? U.S. futures fluctuate after a day of heavy losses on Wall Street, but one corner of the market does show resilience. GameStop closes up 142% over 2 days. Will retail investors be caught holding the bag? Well, good morning, everyone, from London and New York on this Friday, February 26th. I'm Francine Lacqua with Kaylee Lyons. Matt Miller off, probably recovering from some of the losses that we saw yesterday. Kaylee, if you're an investor today, first of all, you look at central banks and you've tested their resolve, so you wonder what they do next, and you just have to take a bet on whether valuations have come down enough to want to be, back into the stock market, or whether they have further lower to go.
Yeah, and what complicates all of this is it is a Friday, so it may be that investors are a little bit reluctant to put risk back on the table ahead of a weekend after a session like we saw yesterday. But to your point about central banks, Francine, I'm waiting to see if the Fed changes its tune at all based off of yesterday's events, because so far they've been saying what's going on in the bond market is healthy, it's fine, it's just the better outlook for growth. Does that change with a 22 basis point move on the 5-year on a Thursday?
Yeah, and probably Jay Powell just saying, guys, did you not listen to me in my testimony for 2 days? Kaylee, what exactly are you looking at the markets today then?
Well, I'm looking at, as we were just discussing, Francine, investors trying to make some kind of decision about what they want to do with risk on this Friday session. We had seen gains in futures. NASDAQ 100 futures now, though, are about flat with about 4 hours to go until the U.S. Open, and the stock 600 over in Europe is down by about 0.5%. And I would note that some risk assets are faring a bit worse than others. Copper futures down 2%. Of course, they had seen a very dramatic run-up in recent weeks. That is unwinding a touch on this Friday. It is all about the bond market and the tantrum that we saw yesterday. Yields are coming in today. That is cooling down a touch. The 10-year yield coming in about 4 basis points, still though sitting at 1.48 or so percent, which is the highest since February of last year. And of course, what was interesting about yesterday's session was the selling in the belly of the curve, the 5-year, where the most dramatic action was, as I said, up 22 basis points. And that actually led to a curve flattening. We have been watching the spread between 5 and 30s widen out as hopes of stimulus, better economic growth have been building in the market, but that did come down to around 148 basis points off the highest level since 2014, still though holding around the highest level since 2015. And as for some movers on the day, we have to talk about GameStop, because Reddit retail traders paying absolutely no mind to anything else that was going on in the market yesterday. At 100% move for GameStop on Wednesday, 19% yesterday, up another 7% in pre-market trading. Beyond Meat also up about 4%. It's partnering with McDonald's and Yum Brands, so bringing its products to the likes of KFC and Pizza Hut. To the downside, though, Salesforce down 2.6% in pre-market after earnings. Sales growth of 20%, but that was the same year-on-year rate as the previous quarter. Investors were looking for a little bit more there. And Virgin Galactic Space, the ticker, down 11.5% after it delayed its next test flight to May. Who knows when Richard Branson himself is going to get to go to space, Francine?
I mean, when are we going to get to space?
Good question.
Mars Land Rover, I have to say there's just so much, it really captured our imagination about what's possible maybe in the next 10, 15 years. Now, joining us to talk about the markets, not about space, is Simon French, Chief Economist at Panmure Gordon. Simon, thank you so much for joining us. When you look at the market route, was it the magnitude of the move that surprised you, or the fact that actually it took all asset classes down with it?
Well, I actually think the thing that surprised me the most was Kaylee's chart that she showed you a couple of minutes ago. Yesterday's moves were actually a bit more at the front end than the back end of the curve. And if we think about your introduction, you talking about central banks being very sanguine about the steepening of the yield curve, that has certainly been the story thus far, and therefore they're not concerned about near-term financing conditions impacting the real economy. Therefore, I was struck not by the sort of scale of the moves, that certainly in their historical context is nothing really to write home about, but it was the shift from the steepening towards a little bit more tightening at the front end, and concerns potentially will start to weigh, particularly in Europe, actually, perhaps not as much in the US, on how that impacts financial conditions.
Okay, is this a classic markets just testing central banks, or is this the markets really believing that the US economy will overheat, and will it overheat?
Well, the enjoyable part of having these conversations with you every month is we can go back over the last few months, last few years, talking about if we trace this back to the flexible average inflation targeting regime unveiled by the Federal Reserve at the Jackson Hole back in 2020, there was certainly a view that view of the Federal Reserve being able to look through and how much tolerance there is to be able to look through was going to be tested at some stage. And therefore, I certainly think this is part of the exercise. The bond market is testing the central bank response function to this new regime. But I also do think that we have to be really honest that the models that are predicting a sustained pickup of inflation because of an overheating of the US economy are based on output gap analysis, which not only has had a really bad track record over the last 5 or 6 years, but also, I mean, we simply do not know the scale of spare capacity for a near 10% stimulus to GDP to feed into.
Well, talking of inflation and risks or concerns about overheating, we're going to have a vote in the House later today here in the U.S. on another $1.9 trillion in fiscal aid. Is that too much stimulus to be pumping into the economy? Are you in the that's going to cause us to overheat camp, or do you think that's necessary?
Well, for all investors, the answer to the question depends on their investing timescale. If you are someone who's very sanguine about the near-term inflationary impact of both the stimulus and the base effects from a very depressed 2020, then I think you're on the wrong side of the trade. I think inflation will pick up, certainly north of 2% by the second half of the year, in our opinion. But it is whether, if you have a longer-term horizon, that will drive a sustained overshoot that central banks need to start lean into. We're much more skeptical on that. We think the big structural deflationary forces that have held down developed country inflation for the last 5 to 10 years are still intact, and arguably, and we talked about this about a month ago, arguably they've been turbocharged by COVID. Those deflationary forces from digital economy that spreads deflationary forces, breaks down pricing monopoly, they've been turbocharged by COVID-19.
And inflation expectations obviously are much more robust here in the U.S. given all of the fiscal stimulus that is much larger than in Europe. In Europe, inflation expectations, particularly in Germany, are still quite depressed. Do you think that is properly priced? Is there going to be more inflation coming in Europe than the market is giving it credit for?
Well, I think it does come back to the question of sustained inflation rather than base effect inflation. We saw the biggest month-on-month increase in Eurozone inflation last month, and we'll see more of those prints that will scare some people that a return of inflation to the Eurozone may occur, and a lot of the bond market is fundamentally mispriced. I don't actually share that view, because I think you're right to cite a 10% stimulus being planned in the US in terms of percentage of GDP is far in excess of what we're seeing in terms of a comparable metric in the Eurozone. And of course, those big structural deflationary forces are more entrenched, more embedded in business and household psyches in Europe than they are in the United States. I think it is more the spillover effect of tightening financial conditions that Europe has to worry about.
Simon, given what we've heard from central banks today, and I know Australia has already done something already, what central bank has it worse? Is it the ECB? Is it, the Fed? If they're being almost attacked or not believed, who has, the most potency to fight it?
I'm afraid for Christine Lagarde and the Governing Council of the ECB, it is that as an institution that I think is most acutely exposed to what we're going to see evolve over the next few months, which is a potential ongoing weakness in the dollar and the commensurate strengthening of the euro, tightening financial conditions. If we start to see the patterns from yesterday at the front end of the yield curve translate into bunds, BTPs, then financing conditions will be key to the bounce back in growth in Europe, is going to be more of an issue. So I'm afraid that is the central bank that stands out as having the hardest problem. But I think all the central banks that are not in explicit yield curve control mode are going to have to consider moving to that same explicit footing as the Bank of Japan have been for a number of years.
All right, we have to leave it there, but thank you so much for your time. Simon French, Chief Economist at Panmure Gordon. Happy Friday to you. A quick check on the markets as we head to break. We are seeing futures holding on to gains in the U.S., the NASDAQ 100, pointing to a higher open to the tune of about 22 points. European markets, though, still in the red, though around the highs of the session, off just about 0.4% on the stock 600 as the 10-year Treasury yield hovers around 1.47%. More next. This is Bloomberg.
Let's just start with the numbers.
It would be essentially free cash flow positive in 2021. That was sooner than people had been expecting.
We have pretty good numbers here in the biggest divisions of Morgan Stanley. They are firing on all cylinders.
We've had this huge rivalry historically between Morgan Stanley and Goldman Sachs.
There are 24 reasons for Mr. Diamond to celebrate today.
As much as people may want to focus on trading, for Bank of America, it's all about credit.
It seems the markets are very happy with Trump. They're very happy with Biden.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
This is Bloomberg Surveillance, the early edition. It's Francine Lacqua in London, Kaylee Lyons in New York, Matt Miller off today. Now, Democrats are suffering a setback in their attempt to push through a $15 an hour minimum wage. The Senate's top rule enforcer said the increase could not be included in President Biden's $1.9 trillion stimulus. Well, joining us now from Washington is Bloomberg's government reporter, Emily Wilkins, on the phone. Emily, as always, thank you so much for coming on. The White House could have the choice to actually ignore this, but they're deciding not to. Why?
So I think if you look at exactly what the makeup of the Senate currently is right now, I mean, even if a parliamentarian did go ahead and approve this $15 minimum wage hike, there is still going to be a question of whether it could actually pass. Remember, Democrats need everyone to be on board, and we've heard some concerns expressed by more moderate senators, including Joe Manchin, that he thinks that the $15 amount is just a little bit too high.
So do they just have to get it out of the relief bill? I know Jen Psaki was saying yesterday in the briefing that Joe Biden is very disappointed at the prospect of this.
Yes, I mean, at this point, it doesn't seem like the $15 minimum wage increase can pass through the relief bill. It's going to have to come out if Democrats want to pass the larger relief package. You have heard Senator Bernie Sanders consider that maybe there's some sort of workaround to this. He's suggested that perhaps they could revoke tax credits from large companies that do not pay their employees a $15 minimum wage. But at this point, the idea has just been floated out there, and it's not clear what exactly might be in the final bill.
Is this minimum wage issue the only hiccup, Emily, or could there be others that would disrupt the path to the bill getting passed in the Senate? Because we know that Joe Manchin, a moderate Democrat whose vote is key to get anything through, has raised some issues with other parts of the bill, right?
Right, and definitely the minimum wage is certainly not the only thing that's coming under scrutiny. I mean, this entire bill basically has to sort of pass this test to make sure that it can be passed through the method that the Democrats want it to be. Everything sort of has to be relevant to the budget and to national spending. And so there's definitely the possibility for other things to not be included, but really the minimum wage has just become such a sticking point because it is something that progressive Democrats very much badly want, and it is something that moderate Democrats have sort of been more hesitant on. And so this is something that the Democratic Party needs to work out their path forward on this particular issue.
Emily, overall, what's been the tone from the Biden administration? It feels, as an outsider, one maybe of more reconciliation, playing by the book, trying to find agreement. Is there anything that actually they'll go very strong on?
The Biden administration has made clear that they do support the $15 minimum wage. But I think overall, I mean, if you look where Biden is focusing his attention on the last number of days and weeks, it has been on coronavirus, on spending, on sort of filling his campaign promise of getting direct checks to Americans. And so that's sort of where we've seen the bulk of the attention from the Biden administration. We certainly haven't seen them say anything, going against the $15 minimum wage. But at this point, it seems like their larger focus is on the overall bill and making sure that that's able to pass.
Thank you so much, Bloomberg Government's Emily Wilkins there with the very latest, of course, on this bill. A very important day for that bill. Now, coming up later today in Washington, D.C., the U.S. Transportation Secretary, Pete Buttigieg, he joins Kevin Cirilli on Bloomberg Radio's Sound On. That's a little bit later at 5 p.m. in New York. And then on Monday, 9 a.m. London time, that's 4 a.m. in New York, the former Bank of England Governor Mervyn King joins us. We talk about budget in the U.K., we talk about inequality, and of course, we talk about U.S. stimulus with Governor King. This is Bloomberg.
It's extremely exciting for the university, for being a historically black college and university. It's just exciting for our engineers to actually be allowed to work for a large firm such as Boeing with such technologies that we can see the outcome.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
It's coming to the forefront of the conversation with all companies, private and public.
Over the course of 2021, we're going to see even more corporate participation in this asset class.
We believe there's a $100 trillion total addressable market for a digital monetary network.
When you aggregate all of these use cases for Bitcoin,
show consumers use cases for this technology, and then they'll understand what it is.
You do get into the trillions of dollars of market cap potential out there.
It makes sense to buy as much of that asset class as we can.
Because really the career risk has gone from why to why not.
Leading voices there, including ARK Invest's Kathy Wood, speaking at the Bloomberg Crypto Summit yesterday. Now, Laura Cooper, our Markets Live macro strategist, joins us. Laura, I feel like the market are finding a little bit of calm right now. If you look at the bond route, if that calms, does it mean that the stock sell-off also calms down?
Well, I think certainly that does appear to be the case. So we did see just these overextended moves in the Treasury market yesterday that did spill over into the Asian overnight session. But with this calmness in kind of the European day, I do think that it sets up for some of that reprieve in that stock correction. We have seen U.S. futures that were previously red now climb back into the green, or the NASDAQ futures are slightly lower, but certainly much less in terms of what we saw earlier in the European day.
Laura, are you expecting central banks to actually take action?
I mean, I think certainly it depends on where we look. I think in the U.S. is certainly having the markets call their bluff. We have seen just this aggressive repricing of rate expectations. Markets now anticipate the Fed to be in a position to hike by late 2022. And that is counter to what the Fed guidance is telling us. They want to maintain this accommodative policy for potentially a number of years because they want to reach that full employment mandate. They want to overheat the economy to get inflation higher, and we're nowhere near that. So I think if we do see yields extend their gains today, the Fed is likely going to have to come out and try to shift their positioning and really kind of capitulate to what markets are signaling, that there is going to be some kind of shift in policy on account of just this U.S. growth exceptionalism that could come through on account of this fiscal impulse.
Laura, looking at the macro, what are the real chances of the Fed raising rates in December 2022, given what we've heard from Fed officials in the last 2 weeks?
Well, I think certainly that's not what they want to do because we still have 10 million Americans